Okay, so today we are looking at this topic of merger valuations. And to deal with the topic of merger valuations, we start by looking at the principles of valuation. And if you remember last time I said to you that a valuation is the present value of the future cash flows. The value of anything is the present value of the future cash flows. And the second rule is that we value like with like. So we try to split a business that has different business operations. Maybe they have a property which they rent out, and then they also have a restaurant in that same property. Then we would value the two separately, isn't it? The building that gets rented out and the restaurant business as separate valuations. And the other key thing, especially when we're dealing with mergers, is that these future cash flows, in the case of a merger, go on to infinity. Do you agree? So I have to do some kind of perpetuity model somewhere in my valuation. When we looked at investments, which we looked again at last week, do you remember we were talking about MIRR and all of that? When we're looking at investments, we're looking at investments with a life. The machine, even if it's plant that's going to be around for 20 years, it has a life, isn't it? When we're dealing with companies, we're dealing with infinity. I've seen one exception where there was an acquisition and there was a valuation for an acquisition that didn't go to perpetuity. It was a company that was buying a franchise. And the franchise had a contract with the shopping center that expired after 5 years. And the shopping center had already said that they weren't going to renew it. Sometimes in shopping centers you get conflicts of interest, right? So, for example, Pick n Pay doesn't want to be in the same shopping center as Woolworths, or if Pick n Pay Liquor or Spa Liquor want to open a liquor store, they don't want a different liquor store in the same shopping center, isn't it? Especially the big players in the market can have a say about the other stores. So in this case, that franchise, the contract was going to end. So we had a useful life. Our useful life was the term of that lease, because after that, that franchise then was dead, isn't it? But for most of our cases, we have a perpetuity. It goes on forever, the cash flow. So we have a perpetuity somewhere in our model. Last week, we talked about these different, the week before, I think, we talked about these different valuation models, isn't it? And if you remember the decision tree that we did, I'm going to do it this way around. The first question we had was, is it a going concern? And when the answer to going concern was no, we did the liquidation method. And that would be unusual, especially in a merger situation, although it's not unheard of for people to buy businesses to asset strip them. You've heard of asset stripping. You buy a business to take the assets out of it and do something else with them and kill the business, isn't it? So I have said to you before that one of my clients once was looking at a takeover target just to acquire machine capacity. Hey, so that's a bit like asset stripping. Hey, the value for them of that company was just the value of that machine, essentially. If the answer is yes, it is a going concern, your next question is it a majority shareholder, a majority percentage? If the answer to majority is no, then it's a minority valuation. And minority valuation is a dividend model. P0 is dividend 1 over R minus G, the dividend model. And you can see that this dividend model is a perpetuity, payment over I, right? And this perpetuity payment over I is you can see it's a little bit modified, where if the dividend growth is only sustainable from year 4, let's say, then this gives you back a value at year 3, and then you still have to take that back to year 0, isn't it? You remember that when we did WACC? We saw those. Right, so when we have not a majority interest, a minority valuation that we're doing, a small percentage, then we do the dividend model, and we sometimes have known dividends and then sustainable growth, and we have to do a combination. You remember that from WAC. If the question to majority is yes, then the majority shareholder can influence the dividend that he gets paid. Because there's no doubt that as a shareholder of shares in a business, the only thing you will ever get are dividends. And so a majority shareholder will be able to influence the dividend, whereas a minority shareholder cannot influence the dividend. They get what they get, isn't it? So when we say a majority shareholder can influence the dividend, what do we need to pay dividends? We need profit and we need cash. We can't pay dividends if we don't have profit or cash, isn't it? And last week we looked at the earnings model. The earnings model was P0 is E1 over earnings yield, or P0 is E1 times PE ratio. We looked at those two last week. You remember working with that, isn't it? All right. So today I'm going to deal with a little bit around that P1 earnings ratio. Let me just see if I can find, here it is. There's a little handout that I want you to be able to do, and I don't have enough of them. I'm going to write it up on the board, then I'll go and make copies for you to keep. So today what I want to focus on a bit more that I feel like we didn't really do enough of is this whole thing with earnings yield and earnings rate and PE ratio. I don't think we've done enough there. I just said to you, this is what it is, isn't it? And I also then want to deal with this last model here, which is called the free cash flow model. So to do this first bit, I have a little table that I want you to complete. And I don't have enough copies, I should have checked. But I have a little table that I want you to complete just so that you can get a feel for how dividends and dividend yield and earnings yield all fit together. So I have two companies, A and B, and I have certain information that I can give you. PE ratio. PE ratio for A is 8. For B, it's 20. So just by looking at that, which is the company that's worth more? Probably B, isn't it? B is worth 20 times their earnings. A is only worth 8 times their earnings. So in terms of total wealth, A could still be more because it could have bigger earnings, isn't it? But in terms of relative wealth, B seems to be a better company, less risky company, isn't it? Or maybe more risky, but more valuable. Earnings per share, 2 Rand and 5 Rand. Dividend cover, 5 and 4. So what does dividend cover mean? It means how many times over you could pay dividends, isn't it? They can pay dividends 5 times over. They can only pay dividends 4 times over. Who's paying bigger dividends? They are, isn't it? Because their dividends is only 4 times earnings. Their dividends is 5 times earnings. So, earnings is 5 times the dividends. Earnings is 4 times the dividend, not the other way around. Dividends is not more than earnings. All right, so what I want you to be able to work out then, if that's the given information, let me just make some more space because I wrote so big. What I want you to be able to work out for me is I want you to work out the share price. I want you to work out the earnings yield. I want you to work out the dividend per share and the dividend yield. Okay, so those are the numbers that I want you to complete on the block. 1, 2, 3, and 4. Okay, these are the formulas. P0 is dividend 1 over dividend yield. Let me just say D1. Dividend yield is R minus G, by the way, because it's the same model. P0 is E1 over earnings yield. P0 is E1 times PE ratio. Yeah? So those are the basic formulas. Dividend cover, you know what dividend cover is, isn't it? Earnings over dividends is dividend cover. How many times earnings covers dividends? Okay, so in this case, if I use the information in this one, it's earnings per share over dividends per share is my dividend cover. All right, let's see what you get. I'm going to go make copies of that one. Okay, so share price should have been easy, right? PE ratio times earnings. So if earnings is 2 Rand and the PE ratio is 8, the share price is 16 Rand. If it's 5 and the PE ratio is 20, it's 100 Rand. 100 Rand per share for share B, 16 Rand per share for share A. Dividends per share should have been the next thing that would be easy to calculate, because I just go earnings divided by cover, and there earnings divided by cover. Flip the formula, in other words. So 40 cents is the dividend for share A, 1 Rand 25 is the dividend for share B. And then earnings yield and dividend yield is just based on the price and the dividend and the price and the earnings. So you'll see that the relationship between earnings and dividends per share is the same relationship that exists between these two. It has to be if you're working with the same share price, isn't it? So earnings is 5 times the dividend, and dividend yield and earnings yield is 5 times the dividend yield, isn't it? It's the same thing. When you look at dividend yield, if you remember from the work that we've previously done on dividend yield is R minus G. So this 2.5 is R minus G. So it's not that the return on equity is 2.5, it's just that once you take off growth, if growth is, say, 6, then the return is actually 8.5, isn't it, that the shareholders expect? And then they get a growth of 6, and then we're discounting it 2.5, the dividend. Yeah? And you can see that if everything is if everything is perfect, sort of in a perfect world, you can see how the numbers flow with each other, isn't it, and balance with each other. Yeah. And so if we're looking at share price purely, and these kind of calculations that I've shown you here, I just want to do that in a highlight color. If you're looking at share price and these kind of calculations to do a valuation, the other thing that becomes quite clear is that in order for us to do a valuation, we need to somehow build in premiums. Do you agree? Because all the numbers and the calcs that I've done are based on one share. And when we're looking at control, and you've looked at control before in FAC, isn't it? There's different levels of control. There's sort of below 25%. At below 25%, you can't even stop a special resolution, isn't it? Because at above 25, you can stop a special resolution. Then there's the gap between 25 and 50, where you don't have control, but you can stop a special resolution if somebody's trying to pass a special resolution. Then between 50 and 75, you have control. Right? And at above 75, you actually have total and complete control, because whatever you want to do in that business, if you want to decide to sell all the assets or whatever you want to do, there's nobody that can stop you, because in the Companies Act, if you remember, the different the highest sort of approval level from shareholders is a special resolution, and special resolutions need a 75% majority, isn't it? So those are the 4 levels of control in a business. And so when we're looking at pricing, we're looking at premiums, and in financial accounting we call these goodwill, yeah, for control, at any of those levels which exceed the 25%, premiums for control. I think in practice there might even be an element of premium there, because we're assuming that all the shareholders pitch for an AGM, and that's probably not technically true. So, if you own 20%, you probably are a big shareholder, isn't it? If you assume that there's an element of people that aren't really active shareholders and that won't really care either way, and then they don't pitch at the meetings, because the percentage votes is for the quorum, the people at the meeting, isn't it, that have signed or that have given proxies. Okay, so you'll see some discussion sometimes about premiums and discounts, and that's what that's about. Okay, so if I go back to my first page here, I had said that when we have majority shareholding, we're looking either at a profit or a free cash flow valuation, and I made you do this. The answers are on the back. You remember, answers are always on the back. Okay? The answers are on the back of that little handout that I gave you with the table. Did I not give you a table? There it is. Yeah. So you can see, and I mean, this is something that comes out of the honors study guides, but I think it's a nice one. It helps you to really see how things flow together and how they work together. All right, so the next thing that I want to look at is the free cash flow valuation. There's a big example of a free cash flow valuation on the back of your handout. And as I said to you earlier, if you're a majority shareholder, you can go to the dividends get approved by a normal resolution of shareholders. So if you own more than 50%, you can pass a resolution to pay a dividend. And what you need to pay a dividend is you need profit. And we looked at the earnings valuation, PE model, EY. And you also need cash. And so that's what we're going to look at today. We're going to look at free cash flow. Free cash flow is the cash flow that's available to pay dividends. Available to pay dividends. So the general model for this free cash flow calculation, FCF, let me do it in blue. The general model for free cash flow starts with profit. Let me see what I started with. I like to start with profit before tax and take off tax actually paid, but I have a feeling that they usually start with profit after. No, I started with profit before, yeah. Starts with profit before tax and initially looks a lot like a cash flow calc. You remember from cash flows in FAC 3704 or in FAC 2602 as well? So I take interest off. Remember, we took interest off in the cash flow calcs as well. Why do I take interest off? Interest is non-operational. It's going to be valued separately. Value separate. I take off non-cash items, depreciation, profit on sale of assets, that kind of stuff. And I then take off tax. Let me say here, add dividends received. But usually we don't see dividends received, but let me just put it on. Interest and dividends received. Interest and dividends received, not operational, value separately. So once I've done that, I land on a number called cash flow from operations. Do you agree? You remember doing it in the cash flow statement when we do cash flows for accounting. You land up with cash flows from operations. Then there's one thing that must come off cash flows from operations. And that thing is capex and working capital. It's the money that you need to retain in your business. So this over here is retain in business. We need to retain money, retain profits. We need to retain money in our business to replace assets for capital expenditure, and we also need to retain money in our business for working capital requirements. If our business is growing, we need more working capital. So the balance then here is free cash flow. free cash flow. And it's exactly that. It's cash that can be used to pay dividends. It's the free cash that I now have that I can use to pay out as a dividend. I've worked out how much cash I have in my business after I've paid tax, but before I've considered non-operational stuff. Then I'm left with the cash flow from operations. If I take out what I need to keep, I've got what I can pay out. Do you agree? This here then represents the future cash flows to my shareholders. Do you agree? So now I have a free cash flow. Let me draw a timeline for you. You are sitting here. It is year naught. You are looking at the present value of the free cash flows, isn't it, in the future? That's what you're looking at. You have a scenario where, let me not draw a line there, let me do a perpetuity there, where you can estimate the cash flows for the next few years. Do you agree? I can, from a budget, from forecasts, predictions, I can go and do this exact calc, maybe for the next 3 years. Yeah? And I can take each one of those and discount it back to today, just like we did with the dividend, if you recall. Yeah? But I have this infinity problem. I have to go to infinity. I can't just take 3 years of free cash flows and say that's the value of my company, because it's not, isn't it? So I apply a model at this stage called, which looks like the dividend growth model. The model that I apply at this stage is this. P, in this case it's 3, is free cash flow 4 divided by WACC minus G. So what I say is, these free cash flows, they're going to carry on into perpetuity. I don't know what the actual amounts are because I haven't done forecasts beyond 3 years. But I have an estimate of what the growth will be. Maybe the estimate of growth is by looking at historic, isn't it? Maybe it's by looking at inflation only, isn't it? Maybe it's just inflation. Maybe it's nothing else. And what I do is I take that free cash flow and I discount it using WACC minus G. This discounting over here, by the way, is also at WACC. We discount free cash flows using WACC. Why? What am I discounting? Operational cash. My cash from operations needs to be used to pay back capital providers, isn't it? So this here represents the cost of capital. And so that's how I discount it back. Cash flow minus G. Once I get this all back here, now you're going to say to me, but now you're saying that this capital belongs to everybody. It belongs to everybody, isn't it? I haven't yet got the value of a share. What I have got at this stage, after I do step 1, let me do it in bold. So I've got a step 1 over here, which is when I work out my free cash flows. Then I've got a step 2 over here, which is when I do the whole PVing of everything, yeah, because I'm also going to PV, obviously I'm also going to PV this amount here also back there, isn't it? So one, I work out the different free cash flows, then I PV everything, year 1 to infinity, right? And then the third step is to actually do my valuation of my shares, because at this stage, all I've got is the value of operations, isn't it? So this, what I have over there, is value of operations. Value of operations is 2 things. It's my free cash flows estimated, the present value of those, and it's the present value to infinity. It's called terminal value. So the value of operations is what I have so far, isn't it? What I did is I said, my operations, what cash flows do they generate? And I have an estimate for 3 years. And then I say it will go on to infinity. And I have a perpetuity valuation to infinity. When I add those two together, I get value of operations. When I take this value of operations and I need to get it to value of shares, I do two things. I add value of other assets. Those other assets are the assets that earn interest or dividends. It's the ones that are moved up at the top there. Do you remember I put the moved interest and dividends, isn't it? I said I don't want to value that together. So value of other assets earn interest and earn dividends. I add those on. Then that gives me the value of the business. I then say my business is financed through equity and debt. Then I say minus value of debt, liabilities, long-term loans, debentures, etc. And you learn to do valuations of those in WACC. And then I'm left with value of shares. Value of shares. So you can see it's quite something, a fair value, a free cash flow valuation. I have not yet seen this asked in this module, but I don't know what could come up. It is part of the syllabus. There are no examples in the study guide, but they refer to the textbook, and the textbook has examples of the free cash flow. So I just don't know. But if you just think of principles, in principle, all I'm doing is looking at what cash is available to pay dividends. And I look at the cash that my operations generate. It's a normal cash flow calc. And then I say, it's the cash that operations generate, excluding other types of assets, excluding my investments, my bank balances, etc. And then I say, how much do I need to keep back and how much can I pay as a dividend? Then I take that, which is the free cash, and I take that from year one to perpetuity and I PV it. I PV it using WACC. And because I always need to have a perpetuity model, I have to use that perpetuity model, which is like the dividend growth, isn't it? Except instead of dividend 4, it's free cash flow 4. Instead of R, it's WACC, because I'm valuing operations. Then I'm left with the value of operations, business operations. My restaurant, in my example that I gave you earlier, which is the present value of the known or estimated cash flows plus the present value of the infinity cash flow, which they call a terminal value, the value to the end. To the value of operations, I add the value of other assets, empty property, interest-bearing assets, investment assets. I put those in, and then I get the value of the business as a whole. But that business is financed through equity and debt. So I take off how much belongs to the debt providers, and I'm left with what belongs to shareholders. It's a huge exercise. But in practice, this is considered to be the most theoretically correct way of doing a valuation. And valuations are done for many reasons. And sometimes we want to get small values for valuations, like if we're doing capital gains, isn't it? Sometimes we want to get big values. But when you're buying a business, right, this is not a shareholder buying one share. A shareholder buying one share would not do this, isn't it? This is somebody wanting to buy a business. If you're wanting to buy somebody's business, what are you going to look at? Profits and cash flow, isn't it? Of that business. That's what you're going to look at. You're not going to look at things like PE ratios and whatever. You're buying the business. If you're just buying shares, then yes, you would look maybe at PE ratio. Maybe if you're just buying 20% of the shares or 30%, you're not looking at this. But this is where you want to buy the whole business. Then when we do mergers, that's what we're wanting to do. And this is the model that we use to do valuations for mergers, isn't it? We look at the company and we say, what are the cash flows from this operation going to be in the future? Because if I have control, I can manage those cash flows. And then I can pay myself out, or I can reinvest them in the business. I can choose what I do, isn't it? And that also influences like this over here. The more money you put into capex here, the more your free cash flow drops. But it makes your cash flows later bigger because it makes growth bigger, isn't it? So it's just all a play. So this is the free cash flow model. There's an example, which I'll take you through, which is in your handout. I know you can't read it, but there you can read it. It's on the back. It's on the top of page 3 in your handout. So I just want to take you through the numbers so you can see how the numbers flow. And in case you get a question, it's maybe something I need to go look for is some questions. There are none in any of the past papers or any of the mock exams or anything like that. And even when it was ACN 308, before it became MAC, also they didn't really like to ask free cash flow. But when you get to honours, it becomes a much more important one. So I just don't know. It's hard for me to explain it to you small because it's not small, isn't it? So here's the information. Forecast information for 3 years. And I've said to you what profit before tax is, interest, tax, profit after tax, working capital requirements for the next 3 years. WACC is 16%. There are no non-cash items. Tax rate is 50%. Growth is estimated at 8%. So my first step is to do the free cash flows for the 3 years that I know. So what I do is I start with profit before tax, I adjust interest, and then I have an adjusted tax number. You can also start with profit after, and when you adjust items, adjust them after tax. Yeah, you get the same answer, you should get the same answer. So then I have no non-cash items, cash from operations. Then I have what I need to keep back for working capital and PPE, and I've got free cash. Yeah, the NPV, if I do an NPV just on that, which is the known cash flows, at 16 is 222,769. You know how to do it? Cash flow 1, cash flow 2, free cash flows on your calculator, CFI or CFJ. Then my terminal value is P3 is free cash flow 4, because I've got 1, 2, 3, I'm working from 4 to infinity, over WACC minus G. Cash flow 4 is 125 plus the 8% growth. So cash flow 4 is 125 plus the 8% growth, and I'm going to divide by 16, which is WACC, less the 8% growth. I'm going to divide by 8. I get a value to perpetuity of 1.6 million. Yeah? But that's at year 3. I need to bring it back to year 0, isn't it? So I bring it back to year 0, and it comes in at 1 million. Now, the value of the company is the 222, which is year 1 to year 3, and it's the 1 million, which is year 4 to infinity. It's exactly the same stuff we did when we were doing the dividends. Total value, 1303. But then there was interest, hey? So there must be liability. So I've just assumed a number. Value of the loan is 300,000, so then value of shares is 1 million. Yeah? So that's an example of free cash flow valuations. Sometimes they give them to you very simplistically. They'll just say, the free cash flow is expected to be this, and the growth is this, and this is WACC. And then you go straight into that perpetuity formula, and you're in year 1, and that's the number. A very, very sort of simple one, isn't it? But just like dividends, there's also a very simple one, where they give you the first year of dividends, and they don't give you all the different stories. They could do the same with this one. And it's the same formula. In the one we use WACC, in the one we use R. Okay, so that's free cash flow valuations. All right, so now I've taught you the different ways to do a valuation. I still haven't talked to you about what happens in a merger. Because what happens in a merger is an interesting thing. There are 2 parties in a merger. There's a seller. Now let's put the buyer on this side. And I get confused because I always put the buyer on this side. There's a buyer and there's a seller when I do a valuation of a merger. And they will negotiate a price. That's how they're going to determine a price. They will negotiate a price. I never know if negotiate is with 2 T's or a C and a T. Anyway, they will negotiate a price. As in any transaction between 2 parties where there's a buyer and a seller, the buyer usually has an idea of the maximum that he's willing to pay for an asset. Do you agree? And the seller has an idea of the minimum that he's willing to take for an asset. So let's use something very simple that you maybe would have dealt with. Textbooks. Let's assume you had bought a textbook and now you want to sell it in the next year. So if you have a textbook that you want to sell, you as the seller have an idea of what it is that you would be willing to sell it for, isn't it? You know how much it cost you, you know how long you've had it, or what it costs new, and you have an idea that, like, if you can't sell it for at least 100 Rand, you won't even bother. You'll rather keep it in case you need to refer to it again. As a buyer, they have an idea of what the maximum is that they're willing to pay, because it would be what the cost would be of a new textbook, isn't it? And that's exactly the same as a merger situation. The buyer has an idea of the maximum that he wants to pay for that business. This maximum is usually a free cash flow value plus the present value of synergies. Do you agree? We talked about synergies a couple of weeks ago, isn't it? And when the buyer is buying this business, he needs to have identified these synergies. We said a few weeks ago that the reason why companies do mergers is because they identify synergies. 1 + 1 is 3, 2 + 2 is 5, isn't it? And so when the buyer is looking at the most that he would be willing to pay for a company, he's looking at what it's worth today, current value, in terms of the cash flows, and he's looking at the value of synergies. Do you agree? When we look at what the seller is willing to sell for, then here it is just current value. And so the negotiation lands up being predominantly about these synergies and about the split of the synergies. How much of that synergy are you attributing to the seller, and how much are you attributing to this buyer, isn't it? So, for example, if we were looking at a product, we could say that product has the ability, if somebody puts money into it, anybody, of growing by a certain amount, isn't it? So that synergy belongs to the seller, because he has a product that if somebody's willing to put money into it, can grow. If it's a synergy that's only because of this specific buyer, only he can make it grow like that, isn't it? Not anybody. Then the synergy belongs to him, isn't it? So like that Oros story that I gave you, there was potential maybe for Oros to become bigger in the market. But the potential that Coke has, because they can put it on every truck, is something that maybe not everybody else has, isn't it? So you take the synergy, and then the price negotiation is all about who gets what. So in a merger situation, if you got a merger question in the exam and they asked you to do a valuation, your first thing is to understand which one you're doing the valuation for. Are you valuing from the buyer's perspective or the seller's perspective? And when you're valuing from the seller's perspective, it's just the current value. So then, depending what information you get given, you might do a dividend model, because maybe the 10 shareholders of 10% each. If they are, then they're willing to accept what they would have got on dividend model. Do you agree? Or you might use earnings, PE ratios, or you might use free cash. It all depends on the information that's given and whether there are minority shareholders or a majority shareholder and all of that. But if you ask to do a valuation from the buyer's perspective, then you have to present value those synergies. There was an example that was actually an honors level example, which always was in your study guide. But I don't think it's there anymore. I was looking for it and I didn't see it. It's called bidder. Your study guide's reduced, I think, in the last year. Yeah, and I had a look this morning. There's nothing in your study guide, no examples. They just refer to the textbook. So we'll have to make some copies of those in the textbook to go through when we're doing revision. There's very little in the textbook, like a couple of pages. But this is a good example to show you this present value of synergies. So bidder is seeking accelerated growth. They want to acquire a company called Target. Very unique names. In the case of this merger, we can expect the following synergies. 50 employees would be made redundant after a with an after-tax retrenchment cost of 1.2 million. So we're going to spend 1.2 million to retrench the employees, but then after that we're going to save 750,000 Rand a year. And wage increases are expected to be double inflation for the next year and equal to inflation after that. Some land and buildings would be sold, so there are some assets we don't need. We'll be able to sell those assets, and they don't need to be replaced. There's some fixed advertising and distribution costs that would be saved. When we advertise the products, we can do it together. When we distribute the products, we can do it together. 150,000 Rand a year for every year. There are some legal costs that are expected to be 3 million Rand. They say that the WACC is 18%, tax is 28%, inflation is 5%, and it's expected to stay the same. They've said there that the intrinsic value has been estimated at 20 million. This value has been determined using an income approach and excludes synergies. So from Target's perspective, their business is worth 20 million Rand. They've done a profit valuation, and the business is worth 20 million Rand. If a company other than Bidder acquired Target, only 40% of the synergy would be realized. So the synergy that belongs to Bidder is 60%, isn't it? And the other 40% is just because it's a good business and anybody could make it good. All right, so when we're looking at the value then that Bidder would be willing to pay, we must just PV the synergies. It's just a PV calc, isn't it? So here's the PV calc. In year naught, we're going to pay 1.2 million, and we're going to pay 3 million costs, yeah, and we're going to sell the land and get 800 back. So do you agree with those three as year naught cash flows? Okay, so in year naught cash flows, 1.2 million out, 3 million out, 800 in. Okay, then the wage savings are 1.2 million is the cost of retrenchment, then I'm going to save 750 a year. But they said for next year, the wage increases will be double inflation. So they'll be 10%. So in the next year, my saving is 10%. After that, my saving is 5%. And it goes on to infinity, isn't it? I have to use a perpetuity formula. So here's the perpetuity formula over here. Cash flow over oh no, come on, because I picked that up. Cash flow over WACC minus G, isn't it? So in year two, right? In year two, my saving is 8.5 plus the 5%. Yeah, and I'm going to discount it at WACC minus G. The growth is 5% every year, right? So I can't keep growing the top by 5%. So what I do is I make the bottom less by 5%. That gives me a value at year one. Do you agree? P1 is cash flow 2 over WACC minus G. And so this is my saving for my wages. 825 for year one, and then 6663,462 from year two to infinity. I've used the perpetuity model. Then advertising is also one that's going to go on forever. It's 150,000 Rand after tax. I don't know, was that after tax already? It must have been. After tax, also 5% a year, year one to infinity. Advertising. Okay, legal we had touched on already, land and building we had touched on. We'll end up with these cash flows. Year naught, year one. In some of the year naught is year one to infinity. In some of the year one there is year two to infinity, isn't it? Stuck in those numbers. They've used discount factors, but we wouldn't have done that. And we would have got a present value of synergies of 3773. So when you're looking at how much Bidder is willing to pay for this business, we get a minimum selling price which is 20 million. And we get a maximum selling price which is 20 plus our synergies, 23,773. Then they say, what is a fair price? A fair price would be to give Target 40% of the synergies, isn't it? Because the maximum that they would be willing to pay would be all the synergies. They will be getting all those synergies. But they have to pay some of that value to the other party. So they said, we should give them 40% synergy. So a fair price would be 21 million. Yeah. So you see how we have a minimum on one side, current state, a maximum on the other, including synergies, and then we meet somewhere in the middle for a negotiated price. But do you agree that this here, this PV of synergies, is just a pure time value of money calculation, isn't it? And you see that they use this sort of adapted Gordon growth model formula with the growth. Whenever we have cash flows that are going to grow at a certain amount, isn't it? We use the discount rate WACC minus G or R minus G to take that into account. All right, so this is an example then of a merger valuation where we have a minimum, a maximum, and a fair value. Okay. Yeah, then there's a discussion about synergies and price recommendations, etc., which we don't need to go into now. There was an assignment question. Oh, yeah, this stuff. Okay. There's one more aspect of merger valuations that I need to cover. And it's got to do with cross-holdings. Last week I gave you an assignment pack, okay, or not? Just checking there if question 5 is that gamma. It is, okay. All right. So this is something that comes out of the old ACN module. It's not covered in the textbook, but they then put it in assignments. So it makes me think that maybe you need to know it. It's got to do with doing a valuation in a merger when there's cross-holdings. So it's just a sort of technicality. And I'm going to show it to you just with an example. Let's assume he has company A and he has B. And let's assume that A has a net asset value of 100, plus they have an investment in B, a 10% investment in B, which is worth another 10. It's sitting in their books at 10. And B has a net asset value of, let's say, 300. Let's say they're a lot bigger. And they have a 20% investment in A, which is sitting in their books at 5 Rand, let's assume. Yeah. When we are looking at doing a merger, we have to determine what is A worth and what is B worth. But because of these cross-holdings, we have a situation where it's iterative, isn't it? Because A is worth 100 plus 10% of B. Do you agree? A is worth 100 plus 10% of B. And B is worth 300 plus 20% of A. And so to get the values, we have to solve simultaneously. You remember that from MAC, okay? To get the values, I have to solve simultaneously. So the only way to solve simultaneously is to substitute. So I have to substitute into this bottom one. I'm going to substitute. And I'm going to say 300 plus 20% of 100 plus 10% of B. Like that. Yeah? And so if I carry on substituting, I get 300 plus 20 plus 2% of B. Do you agree with that? 20% of 10% is 2%. Okay. Then I'm going to bring this to this side. So then I'll end up with 98% of B equal to 320. And then B is equal to of course, my phone had to die now. Three to 6. Just going to keep it whole. And if B is equal to 3 to 6, then A is equal to 100 plus 32.6, 10%, 132.6 is what they are equal to. Yeah. If you add, is that right? Did I make a mistake? No. 400. 10%. Yeah. So when I bring the assets in, then I can then I need to then do a calculation which says if I'm issuing shares to A's shareholders and B's shareholders, how many shares am I going to issue? Based on the values of the companies, isn't it? Because if I prepare a statistical position, I'm going to have, for my new company, I'm going to have net asset value of 400, and I'm going to have share capital of 400. And if I'm just merging the companies, that share capital will be for A's shareholder and B's shareholder, Mr. A and Mr. B. Yeah, and I need to figure out the proportion that goes to each one of those. And if you look at the calculation, A's shareholder is entitled to 132.6 of A, except for 20% of A, which he doesn't own. You agree he doesn't own 20%? And B's shareholder is entitled to the value of B, except for 10%, which he doesn't own. Do you agree with that? If I'm looking at who owns the shares. So if I'm looking at who owns the share, Mr. A, Mr. B. So if I take those numbers off, it should balance to the 400. But you're going to practice one so you can see. Oh, there's my calculator there. It's 26.5. 106.1. 293.4 is 400. Yeah. So when I'm looking at the share capital, just to round it, he will get 106 and he will get 294. Yeah. So there is this question in this assignment, which I'm just scared that it'll come up with this cross-holding story, and then you will never have seen it, isn't it? So I don't know. They've struggled with this module to roll over from what they did before, where sometimes there are things that aren't covered in the textbook, because there was a different textbook before, and that are not covered in the new textbook, but then the examiners will examine it, or will put it in the assignments, isn't it? And then you're like, okay, but that's not covered in the textbook that you've required the students to read. So this was an assignment question from 2014, where they said to you, you have the following companies. It's the assignment pack that I gave you last time. Gamma and Memento. Gamma and Memento have PPE, they have investments in each other, and they have share capital and retained earnings. They've decided to merge, and they're going to form a new company called Robust. Robust is going to take over the assets at the following values, which they've said are fair values, 1650 and 900. They're also going to pay goodwill. So we're going to have goodwill. Remember, whenever we have business acquisitions, we have goodwill, isn't it? So we have a company called Robust that essentially is going to acquire Gamma and Memento. So there's going to be two amounts of goodwill. The amount of goodwill is calculated on the following: future profit per year, fair rate of return, super profits. So this is a bit like residual income. Do you remember when we did residual income? You're going to take the residual income by looking at the fair rate of return compared to what they will get. You'll get residual income, and you're going to PV it over the 3 years. Yeah. Super profits. The purchase will be settled by issuing shares of 2 Rand each. They ask you to calculate how many shares will be issued. It's a merger question. So over here, maybe I can just give you the goodwill. I don't know. This is also a method of This is the valuation method, the super profits method. That was also in the old textbook, but isn't in the new one. So maybe I should just cross-holding, total value. No, it's in the previous one. The goodwill. There's the goodwill numbers. So I'll just take you through the calc quickly, and then we'll just put them on. So goodwill, we start with the actual profit, what they will make. Then we compare with what they should make, 12%, and we get to something which is like residual income. Do you agree? What they should make, what they did make, what's extra. And then they take that residual income and they PV it over 3 years. So this becomes payment over 3 years. This is the goodwill they get. 240 and 102. So 240.2, 102, 168. 240.2 and 102.68. So over here, where they're talking about here what they're going to take the assets over at, I want you to just use 240. No, come on. 240.2 and 102. I knew I was going to forget that. 168. Okay. So we have goodwill now, just to add to our numbers. So what you're going to do is you're going to take those numbers, the PPE numbers, add goodwill, work out the cross-holding and do your formulas to work out the values, and then work out what Mr. A and Mr. B get, and see if you can work out the values. So you should have the assignment in front of you. I'm going to leave an example here so that you can try follow it. We won't come across this again, but this was a very big section in the old ACN 308 module, cross-holdings and mergers. You've got that assignment? You should all have it from last week. I should have somewhere. Yeah. Because for this module, we don't have a lot of past papers. We have 2 years, is it? 1 year? 2 years. No, I think 14 was the first year. Oh, you're doing it. I think I only have from 2014. Did you see? Yeah, 2014 was the first year. There was a mock exam that was given out in 2014 for the students that wrote that year. But I only have 2014, 2015. So 4 past papers is all we've got. So when we have so few past papers, we have to sort of rely on assignments, isn't it? This was the assignment, the first assignment in 2014, the big one. And this was one of the questions, this question 5, for this merger. So let me see if you can do that valuation for me. Valuation of A and B using the substitution, the cross holdings. So what you're going to have, which I didn't have, is you're going to have a goodwill, whatever the goodwill is, numbers. And so then this value here will include the goodwill. Yeah, because I'm paying goodwill for the 2 companies. 240.2 and 102. 240.2, 102, 168. Those were the goodwill numbers. 240.2 and 102. Okay, so there's the goodwill numbers. Not the ones that related to this question, but the ones that... sorry, I'm going to just move them across here. The ones that related to the question that I've asked you to do. Possible? Doable? They've given you the values there. That's the values they're going to buy the assets at. So it's those values plus goodwill is what you're going to use here instead of 100 and 300. And you're going to work out your cross-holding. Okay, so it's an example of a valuation with a cross-holding. Sometimes they do one of these and they do a little bit of a valuation to get to the goodwill. Yeah, because goodwill is the difference between the value you work out doing a valuation model and the net asset value that's shown on the face, isn't it? So here they said we had a super profits method, but they could have given you one of the other methods that you have learned. So here they gave you what value they're going to take the PPE over at, and then they gave you a goodwill. And so when they take these two companies, the new financial position will have PPE of 2550 and goodwill of 342368. So it needs to balance with share capital. In order to do that, we need to work out the value of each company so that we can work out what each shareholder gets. G is 1890.2, which is the two PPE and goodwill together, plus 20% of M. M is 1002,168 and 10% of G, the cross-holding. So when you solve, you get G 2.133.3 million, M 1215.498. Then when we're working out what the shareholders own, because of the cross-holding, they own less, isn't it? So G, 10% of G is owned by M, so the shareholder of G only owns the remaining 90%. There it is. And for M, 20% of M is owned by G, so the shareholder only owns the remaining 80%. So all I did is I took off 10% there, took off 20 here, and those are the values of the shares. So then if I had to do they then said to you, how many shares must they issue if they are 2 rand shares? I just divided by 2. 959,985 and 486,199. And then if you had to do a statement of financial position, add the PPEs, add the goodwills. That's going to be my new company. There's no retained earnings in my new company. It's brand new, isn't it? 0 retained earnings. So when the company starts day 1, it will have PPE, goodwill, and it will have share capital. The share capital it will have is G 1919970 and M 972,398. And they have to balance. Otherwise, if they don't, you've made a mistake somewhere along the line. Okay, I'm just scared something like this comes up, because it came up in this assignment and you just never know. But it's part of mergers, isn't it? So just to recap, so the solution is then here, the whole solution. Just to recap what we were talking about today. So today we were talking about valuations, and specifically valuations in a merger scenario. So I started off talking about when we have valuations of a merger, what the principles are in terms of valuation. And usually your merger is a going concern, so we wouldn't use liquidation method, but it could be that it's not. If you asset stripping, then it's not. If you have minority shareholders, you might do a dividend model valuation, but if you're buying the whole business, then you might do a majority shareholder valuation, and then that would be earnings yield, a profit or earnings valuation, or a cash valuation. I took you through this, which showed you the relationships between the different formulas for dividend and earnings and how they sort of go with each other, how they flow. And then we looked at the different premiums that would exist in a merger scenario. The amounts of the premiums are very subjective, what that amount would be. It could be, I suppose we're looking at the difference really between a dividend valuation and a free cash flow, isn't it? Which show you that premium perhaps. Then we talked about the free cash flow model. I showed you how the free cash flow model worked. But in essence, it's quite a complicated model. It could be asked more simplistically, which is it's the cash that's free to pay dividends. And it's the present value to infinity. So somewhere in this cash flow model will always be this formula. It has to be there because in all our formulas, we have to have some kind of perpetuity happening. And then I talked to you, then we went through an example, and then I talked to you about in a merger scenario how the valuation would work. And in a merger scenario, we have to value the synergies. So we went through an example where we valued synergies, and I talked to you about a minimum and maximum price and a negotiated price in the middle. In the exam, you could get something where they give you the synergies and ask you to place a value on them and then recommend a price. Yeah, it should be fairly easy. From the minimum price perspective, sometimes they'll give you a price or they'll give you a share price. That would be the minimum price. And then we would have on the side synergies. So we worked through this bidder example with the synergies. But it was just present value of cash flows, isn't it? Time value of money. And then lastly, I showed you a scenario where if there's a cross-holding, we would have to use these simultaneous equations to work out the values, isn't it? Because we have invested in each other, and so we start to go around in a circle. Yeah. So remember, we could have a cross-holding where they ask you to do a calculation to get the value of A without its investment in B separate, isn't it? So they could say, this is the value of A without the investment in B. And it could be operations, it could be earnings, it could be whatever. And then they could do the same for B. And then to get the true values because of the cross-holdings, we have to apply the simultaneous equations to simultaneously solve. And then it gives you like strange values then for A and B, isn't it? Because they have shares in each other. All right, next time when we meet to wrap up, basically we've got 2 lectures left. We've got a lecture where we're going to talk about how we finance mergers. This one went a bit into that because this one is financed through like a share swap almost, isn't it? Mr. A gives up his shares in A to get shares in that new company. In the example that we did here, the shareholder of Gamma gives up his shares in Gamma and gets shares in Robust. And the shareholder of Memento gives up his shares in Memento to get. So that is one of the options we're going to look at, share swaps. We're going to look at cash. We're going to look at borrowing money to fund mergers. We're going to look at issuing rights issues to existing shareholders, and we're going to look at how we decide how to finance a merger. So that we'll do next time, and then that's lecture 9, and then lecture 10 will be just some treasury stuff around dividends, forex, interest rate risk, small bits. And then we're done, and then we're going to start doing past papers. Okay, so next week, I'm not here. If you want to come, you can come. You can sit here in the class and watch the board, but I'm not here. Assignments are due? They were due already. Oh, this one was due the 22nd. So this one's due the 2701. Other way around, perhaps. I don't know. I'm not quite sure what's happening with dates. But all these things with assignment dates just means that the assignments are never going to be marked sort of in time for any decision making. Your objective has to be to actually pass that paper, isn't it? And the paper is way late, is it? Let's finish the syllabus and then we talk about where you are at. Because if you've got lots of stuff coming up soon, you're going to be saying, no, I don't want to think about MAC now for a while, isn't it? So, but I don't know. Let's see. Let's finish the syllabus. So 2 more weeks to finish the syllabus. That's the case for like most of our modules. 10 weeks to finish the syllabus and then revision and past exam papers. So I won't see you next week, but I'll see you the week after.